Okay, well, welcome everybody to Nucleus Insights Ethical Investing. So this is the next iteration of our quite popular Insights program through Nucleus Wealth. And today we'll be discussing the ins and outs of ethical investing, some areas of interest, and also some areas that Nucleus Wealth are focusing in on. So let's get underway. Just before we do, of course, as always, we need to just quickly run through a quick disclaimer that obviously any information discussed today is of general information only. And whilst Nucleus Wealth aims to present informing and hopefully sometimes entertaining content, please always consult your investment professional or financial advisor before making any decisions from what we've discussed today in today's webinar, or have a chat to us. So quick introduction. So myself, Tim Fuller, certified financial advisor, been working in front of retail and mum and dad investors for a number of years. Really enjoy it. Love hearing the stories and finding ways of helping people navigate their way through the maze that's sometimes fairly complex when it comes to personal finances. And of course, sitting across from me today is our head of investments, Damien Klassen, who, as you can see there, has got a quite more substantial list of accolades to his name, with working with the likes of Schroders, Wilson HTM, and also the founding partner of a equities analyst company called Aegis, which was in the 2000s. So welcome to you, Damien.
Thanks, Tim.
So what we're going to talk about today. So the agenda for today is really obviously focusing in on ethics and how they interact with investments. Looking at specifically what ethics or investing ethically can do to things like the performance of a person's portfolio, which is obviously a key reason for investing in any asset class. Running through that in depth with Damien there, and also then finishing up with some options that are available out there currently in the market for investing ethically. A couple of definitions. So I guess, and I'm borrowing a little bit here from an ethical advisor, a good friend of mine, who likes to, when he sits down face to face with people, so I guess class as to what sort of an ethical advisor they are, or how not so much how ethical they are, but to what degree they'd like to take it. And look, he uses the term, I think it's quite common in the industry, of a light green to a dark green investor, and so I guess typically you see at the top there what's called sustainable investing. So this is where investments are chosen on the basis of really how they manage environmental, social, and corporate governance factors, not so much specifically on what the company makes or sells. In the middle there, socially responsible investing. So companies then are generally, in this case, are screened out if they take part in any preset or excluded activities. But they may be included, however, if their commitment to social responsibility somewhat outweighs the negative aspects of their, what they do for their business. And then finally, I guess the full-blown ethical piece is really then looking at companies and entire sectors in some cases being negatively screened out and not included in portfolios if they make or sell certain products or are involved in certain services. And the other side of that then again is now is what's called positive screening. So it's knocking them out to negative and adding them in as positive, but we'll talk about that in a couple of moments with Damien. Broadly speaking, I think ethical investing is probably largely headed fits under the one banner now. It's I think it's taken a number of twists and turns over the years, but it sort of seems to largely sit under this term, which is ESG, environmental, social, and governance. So we'll just quickly take a couple of moments to run through those. So from an environmental aspect, the criteria typically looks at how a company performs as a steward of the natural environment, basically. In order to pass the test here, an analyst would look at company energy use, waste, pollution, and the way perhaps they treat animals if they're involved with animals as well. From a social aspect, typically you look to examine how a company manages relationships with its employees, suppliers, customers, and the communities that they operate in. Particularly looking at perhaps the way it works with suppliers, for example, holding the same values that the company itself claims to hold. Whether or not it donates any percentage of profits to community, community avenues, or performs any volunteer work, and generally just looking at employee health and safety and the track record in that area as well. Finally, governance, and this is a big one, and Damien will be diving into this one a little bit later on, but this is now looking at more, I guess, the top level, looking at the company's leadership, executive pay, which is a contentious issue, internal controls, also looking at the types of accounting methods used, whether they're accurate and transparent, and also looking to see that typically a common stockholder is allowed to vote on important issues. I guess the other side of it, of course, as well, is always looking to make sure that the governments, that the companies are investing in, that are being invested in, rather, are not engaging in illegal behaviour, or another big one is using political contributions to obtain favourable treatment. So that's ESG, and what we can do now is, I guess, look at some of the areas with Damien. But ultimately, I guess from an ethical standpoint, it's less about the ethics as such, and more about yourself when you're looking at it from a personal investment standpoint, and then going, okay, well, here's what I believe in, and then how do I sort of work this through my portfolio. So what we'll do now is we'll bring in Damien.
Thanks, Tim. Yeah, look, I wanted to sort of focus on three things. The effect on investment performance, which is probably the biggest one. So, by investing ethically, how much are you actually giving up? How much are you leaving on the table? The second part is, how are we choosing the stocks that go into it? And there's a range of different ways you can choose and methods to find the stocks that are going to go in. And the last one is fees, where there's a number of players out there who invest in ethical products, but I'd suggest the fees they charge aren't particularly ethical. So making sure you do have a good look at that and what level you are actually paying on those. So,
this is a big one. So I guess I'm thinking about if you're going to apply sort of screens, and we might elaborate on that in a minute. But ultimately, what happens to a person who says, okay, I want to invest under these certain ethical regime? What happens to a portfolio?
Yeah. Now, I mean, there's I sort of picked up on this. But one of the reasons for doing this was there's an article by CanStar recently that sort of and CanStar sort of rate a lot of funds or a lot of financial products, and they were sort of asked, do responsible investment funds perform as well? And their answer was yes, and in fact they often perform better. And that's completely wrong in my view, is that you can't be telling people invest ethically and you're going to do better than if you invest otherwise. Because in the end, as an investment manager, a lot of investment managers who are given ethical portfolios, they're the same investment managers that are managing other portfolios, and all that you're doing is giving them a reduced set of stocks to invest in. So, for example, the example I like to use is 1,600 stocks in the world index, and these are all mega caps, sort of very large stocks that are the largest stocks in the world. And so if you can imagine, if you're a fund manager and you could choose any stock you wanted to invest in out of that and create a portfolio for it, and then somebody says, okay, well, rather than that 1,600, I'm going to give you 800 of those that are the more ethically sound version of those ones, and I'd like you to go and outperform the first person who can pick from 1,600. So I guess what I'm saying is, you reduce the opportunity set. In the long term, you're probably going to reduce the potential for people to outperform. Now, it doesn't mean you always underperform, and got a few real world examples that sort of might give you an idea of this. So the last 4 years, what I'm sort of showing here on screen is the top line. The blue line is oil and gas stocks. Oh, sorry, the green line at the bottom is oil and gas stocks, and the blue line is the world index. So you can see that they've greatly underperformed. They're sort of down 30-something%, and the world's up 30% over that same time frame. This is why you get these articles coming up like the CanStar ones, because things like oil and gas stocks are usually a negative ethical screen. So there's carbon metrics in a lot of the people's ethical portfolios. And so if you're investing in an ethical portfolio, the chances are they didn't own very many oil and gas stocks. And so the fact that that sector went down, and it's quite a large sector, meant that you almost by definition managed to avoid those losers, and you went up. On the flip side, I've got another one here. There's a lot of ethical funds out there that are ex-tobacco stocks. So they basically run a world similar type of portfolio, world or an Australian portfolio, but they're not allowed to buy any tobacco stocks. And these have generally tended to underperform over the last 10 years, not because the tobacco stocks, as you can see there, are up sort of almost 300% versus the market over that 10-year period. So, I guess where I'm coming back to is we've reduced the opportunity set. Doesn't necessarily mean ethical stocks are always going to underperform or always going to outperform, but the odds are, on average, you're probably going to end up underperforming a little bit because you've just got fewer stocks in there. So
would it be safe to say, I guess, that if a person was to enter, say, and assuming these are over the same time frame, which I think is not too far off, if you were to get into an ethical fund that perhaps knocked out, climate change sort of influence, carbon-related industries, which is quite a big one, as you mentioned, but then also tobacco, that, obviously there's a bit of hedging perhaps a little bit there, but at the same time you're missing out on, for example, if an investor was, obviously getting into it for the carbon side of things, but was fairly ambivalent about the tobacco side, perhaps?
Yeah, certainly. And that's a lot of what comes back to, it's a question about how many things you'd like to knock out. So if you're knocking out half the universe, that's obviously making a bigger difference in terms of the performance potential than if you're only knocking out, 5 or 10% of the universe that you just feel not willing to invest in.
Okay. Corporate governance. So why is this one the exception, mate?
Yeah, so most quantitative analysis that you do, where you sort of look back through sort of back tests and how companies perform, shows that corporate governance generally, which is sort of the G in that ESG factor, they do tend to perform better over the long term, but there are some pretty large caveats with any of these that you come up with. So there are plenty of counterexamples of companies that do have poor corporate governance that still do particularly well. So as with most quant factors, these are a tendency, not a guarantee in any of those. The second thing, which is probably more important, is that the price matters the most. If you can buy two similar companies at a similar price, then you'll find, and one has poor corporate governance and the other one has good corporate governance, then you'll tend to find the one that has good corporate governance will perform better in the long term. The issue though comes down back to, if I can buy the one with bad corporate governance at a 50% discount to the other one, now that underperformance tends to go away. And the question is that, what level is it? How much cheaper should you be buying stocks with poor corporate governance versus ones with good corporate governance to make up for that? Okay. So the first one is that all these things tend to work. Secondly, price matters. So buying at what price you're buying it, and finally is that really there's corporate governance is very subjective. There's sort of many elements that are very much shades of grey, and so the question is how much you should weight them. So I'll use a favourite of people looking at this is Google or Alphabet. So they've got, on one hand, they have a structure that gives the founders more votes than other shareholders. So they've got sort of a non-voting and a voting share, and that's usually thought of as bad corporate governance, going to one section of shareholders and letting them have more say than other shareholders. On the flip side, they've got a large, diverse board, and they've got a majority of non-executive directors on there. So you haven't got sort of insiders determining everything, and that's generally good corporate governance. So you've got one company with elements of bad corporate governance and elements of good corporate governance. How much you weight them and which one's more important, that's where it gets very grey in terms of this area and how you actually, how they get measured.
So it's really, what you're saying there is it's really down to the subjectiveness of the individual manager, perhaps, to draw the line.
Absolutely, as to what's going to work there. So so corporate governance good, but with caveats. Yeah.
Okay, very good. And so I guess ultimately, though, you're saying there are some pretty serious impacts sometimes, both positive and negative, on portfolios. ultimately, what are we talking though in the broader picture?
Yeah, so look, on here I've got less than 0.5%, and it is considerably less than 0.5%, but it does for a lot of screens. And this is a theoretical type of return. That's saying potential. So it all comes back to how much you're going to remove, though. If you're knocking out 5 or 10% of the market, the chances are that the effects are going to be pretty small. And so, as an example, at Nucleus, we sort of let people customize portfolios to their own ethics. A common one we have is removing cluster munitions. Now, cluster munitions are the bombs that one bomb falls and then all these other bombs come out of it, and quite often they don't explode, and years later, kids are playing and get hit by these bombs. There's a UN resolution out there that the 100 and something countries have all signed up to, but the big ones, China, US, and Russia, haven't signed up to it. And so a common ethical screen is to say, well, let's not buy companies that are involved in cluster munitions. If you did that, you're only dropping out a handful of companies, and you're probably going to have very little, if any, meaningful effect on performance. On the flip side, we can then say, well, we'd like to take out any companies involved in weapons manufacturing. And so that'll take out all the US defense contractors, but it's also going to take out stocks that you might not have thought of, like Boeing, for example. Not only does it make planes for passenger jets, but it also makes planes for the US Army. And drones, yeah. And so those types of things where, and that will then make a little bit bigger of an effect. But I'd say for most people, and I sort of ran some simulations on this, and I knocked out about 25% of stocks, sort of made sector outperformance a bit random. And the final thing is you have to assume that investment managers do have some skill in terms of picking stocks, and then you get sort of performance hits of less than that 0.5%.
Wow. Yep. Okay. So I guess, and then...
sorry, actually, I should just disclaim quickly, in individual years, it can obviously be much larger. You can get 2 or 3% at least, in either direction, but, it's just that long term.
Long term. Okay. Yeah, sure. And I guess then practically, being a fund manager yourself, a client comes to you and says, okay, I like these ethics. I like these, various things that you put forward. It might be climate change. There might be, as you said before, the munitions sort of side of it in there as well. What typically then, practically, behind the scenes happens to make this happen?
Yeah, sure. So there's generally 3 types of funds now that are out there. There's the positive, the negative, and the best of breed, as I call them. The positive ones. These are the guys that set up an ethical fund, and they're trying to find companies that are sort of actively contributing to causes you might feel strongly about. Solar manufacturers, biotechs with cures for cancer, electric car manufacturers, those types of things. So the tough thing with positive screening, though, is we're looking for stock. We're trying to look for stocks that are going to outperform. So if you're trying to find stocks that are good quality, they're cheap, and they're also going to help the environment. These are the unicorns that you very, very rarely manage to stumble over in your portfolio. And so the question comes back to saying, well, if I find one that's good quality and it's helping the environment, but it's very expensive, should I still buy it? Sort of expecting a poor return on it. The positive screening, they're certainly helpful, but and I've got another thing I'll discuss a little bit more detail a little bit later on this. But the positive screens are tough. Negative screening is what we are talking about before, about excluding. So you basically try and find companies that don't hit your ethical standards, and then you come back to that part about the more you want to cut out, the more potential underperformance you have. So for me, this is a lot about customizing. You want to sort of find somebody who's got the same views as you, and so and find an ethical manager where you can line up and they're not cutting out large swathes of the market that you might be ambivalent about or happy to invest in, and whereas the manager you've gone to isn't doing that. And then finally, the best of breed. Now these ones are what they do is they tend to rank all the companies. So you rank them all on these various metrics, and then you try and pick the ones that are best within the category. So for example, if you're looking at the energy sector, you might end up investing in companies that are involved in gas, because gas is less polluting than oil, and it's less polluting than coal and the tar sands and things like that. So that might be fine for some people, but for others, they're sort of saying, well, I didn't want, I wasn't asking you to just pick the one that's polluting the worst, the least. Sorry, I'm asking for no pollution. I'd actually like to cut them out of that. And so that's sort of the best of breed one works for some people in that it tends to invest in companies that are trying and making an effort, but you run into that little bit the similar problem with the positive screening about trying to find companies good and cheap and best of breed. But also you do actually end up investing in companies that you might not have wanted any to. So you might not like tobacco, and they've bought a tobacco one that's the most honest and isn't exploiting third world countries and stuff like that, but it's still a tobacco stock.
Okay, very good. Thanks, Sam. And I guess, and in regards to just investing in ethical at all, and I class myself as a pretty ethical bloke. We installed solar this year. I sort my soft and my hard plastics out. We buy the free range eggs from the supermarket. So are these just typically day-to-day things that I should be chasing up now in my portfolio, or?
Yeah, well, this is what one of the things I like to approach people with is do you really want to be investing? Do you want to be mixing your ethics with your with it, or are there actually better ways for you to do it? Now, I'm a bit of a sucker for biotech stories. If I hear a good biotech story, I tend to avoid them because I know I'm a sucker for it. You look at these things and this company talks about how they're going to cure a disease, and they show you pictures of kids who are going to be saved when their drug or their new device works, and you hear about it's a very uplifting experience, listening to these stories, and you're thinking to yourself, look, hey, not only am I going to make money out of this, but I'm going to be saving the world, and helping to cure cancer or whatever the thing is. But most of these companies never focus on price. It's all about it's all about what they're doing and the whole process of doing it. And a lot of these companies do actually end up losing money over time. And so every now and again you get one that goes fantastically well, but on average, most of the companies end up losing money. Now, it's I guess what I'd like to come back to ask people and say, look, if this is something you truly feel passionate about, say it's curing cancer and you found a company that's got a potential cure for it, is saying, well, maybe you should make a donation to the Cancer Foundation or make a donation to one of these. You get your tax deduction up front rather than investing in a company that might actually lose money over time and waiting for 4 or 5 years before you take a capital loss on it. So, the question is, would a donation actually, give you the same or even a better outcome? The company you're investing in, the thing you're trying to help, if it's trying to cure cancer, is probably better off with you making a donation than what they are with you buying some shares in a company. The second step down there is buy the product yourself. There are particular cases where if there's companies out there that produce free range eggs, for example, they should be happier to have you as a customer rather than a shareholder. If a company is happier to have you as a shareholder rather than a customer, I suspect they've got something wrong when they're potentially running a scheme that's all about bringing investors in and not actually about selling products. And so the first buy their products. Second is buy their products. The third one is then, if you do want to invest in a company that's for a positive ethical reason, so these are all positive ones. Buy shares in a capital raising, or make sure, because that's the money where the company is actually raising money to invest in research or invest in whatever to actually produce a return from this. And so if you give the money in a capital raising, that money goes to the company, and the company will use that to pay salaries and do this research and development. Yep. But the last one, which is actually buying shares on the market, what I'm doing is I'm buying shares on the market. I'm giving my money to another investor. The company, maybe the share price will go up a little bit, but the net effect to the company is very, very little. So if you're find a positive investing stock and you want to have a look at it, I'd advise you have a look at this list, start at the top and work out, track your way down before you get to that final step of buying shares on the market. That buying shares should be about the wanting to make a decent return on it. And if you're just buying it purely for altruistic reasons, there's probably better ways you could spend your money.
Yeah. Okay. No, fantastic. I hadn't thought of that. So that's good. I guess finally, the all important. All services cost money. So, what are your feelings on fees, and where do you think you sit? Where do you think you sit there? So,
well, look, this is certainly one that irks me greatly when I look through some of the PDSs, the product disclosure statements you get from some ethical funds, and you see fees in there that are hedge fund type fees, and they're radically higher than, 2 or 3 times higher than what you might see elsewhere. And really what they're doing is the same investment that most other people are doing. They're just cutting out some stocks. They're reducing the universe and letting their fund managers go and invest. And for that, they want to charge 2 or 3 times as much as a typical fund. So the first thing I'd say is, and the reason why I think that comes about is because the managers find that when people are thinking about investing ethically, they don't look at the fees as much. They just want to know that, is this somebody who's going to look after my money and is not going to go out and buy uranium companies or these carbon companies. So I guess where I'm coming back to is, you want to make sure the guy who's running it is also ethical in the way they charge and the way they run their business. So don't forget to look at the fees when you're going through these. To give you a rough guide, we charge about, and Tim will go into this a little bit more detail. We charge about 1% to run funds. You can get exchange traded funds for somewhere between 0.5 and 1. So lots of our competitors, you don't want to be paying too much more than that.
And I guess ultimately, when you mentioned before that there is the potential in the long run for some impairment due to ethical screening, then obviously the fee on top of that is adding insult to injury perhaps sometimes.
Absolutely.
Okay, sure thing. Okay, well, so what we'll do now is we'll just move into where to invest. So hopefully that's provided enough information. And look, feel free at this point, if you've got any questions, we've got our live chat box at the bottom there of your screen, and we've got Maddie, our communications expert, on standby to monitor for any questions. So feel free to fire any through. But look, broadly speaking, from a broad, certainly from a broad thematic sort of group set, the list there, and I've got the little coloured bar down the side just to give you an indication of typical fees. But at the top sits managed funds, and there are plenty of them out there. I can reel off a few names: AMP and AXA, Australian Ethical, quite big in this space, of course, BT, Perpetual, and the Uniting Church, funnily enough. Look, one of the things there, I guess, with managed funds is outside of the management themselves, you do typically need to pay some form of a platform fee, which then gets added on top, and then potentially some advice fees perhaps as well to help give you some navigation through those. So that's, I guess, what gives those a bit of a glowing red. In the middle sits what's called listed investment companies. So these are run principally the same as a managed fund. However, you can buy these generally on the stock exchange. So it knocks away some of the levels of costs to do with the platforms. But largely speaking, they sort of sit in the sort of 0.8 to 1.6 or more % range, just by themselves. And then finally, at the bottom there, quite a common one these days, and certainly getting a lot of attention, a lot of popularity, are exchange traded funds. So once again, listed on the Aussie Stock Exchange. These are typically at the lower end of the fee sort of ranges that you can get, between about 0.5% to 1.2, 1.3 I've seen them for. Beta shares is quite a big one, and also Russell Investments and UBS are quite well known. There's, if you have a look at the bottom there, responsiblereturns.com.au is a panel of or a tool that you can use to deep dive a little bit further into some of the ones that have been graded by the Responsible Investment Association of Australia, which I guess is one of the leading ethical bodies that companies, investment companies, can sort of submit their portfolios to for grading and see if they pass the test. So feel free to check out there for further detail. So that was a broader thematics, and then I guess the next stage is then looking at what's called tailored thematics. So now this is where you might approach an ethical financial advisor, for example, and a shout out to Mike at Ethical Investment Services, who actually gave us a hand in putting together our screens. And this is obviously more of a one-on-one relationship, sitting down and actually going through the ethical feelings you have, and then getting an advisor to help you translate that into various products and make a recommendation. And then ultimately, I guess the other side of the tailored end is separately managed accounts, which is similar to you can have an individual share portfolio, however, and by the way, this is what we use, is then it's managed on a group level. In terms of the running costs and everything else are substantially cheaper, which helps with the fees, such as our fee. But then ultimately you want to have the control over the ethics, and we do that, and quite a few people do that through what's called ethical screening. But we'll have a chat about those in a minute. Probably just the points to consider when you are going down this path, if you're having a look and doing a bit of your own research, is number one is, ultimately, of course, whether or not your ethics are being reflected, in the management of your money. Are you getting what you pay for? On that similar vein, you looking at, I guess, and Damien mentioned it before, that you need to make sure that at the end of the day, the price you're paying for the service is reflected in the amount of effort that they're actually putting in, and the styles of investing they're doing. As we said, as I said moments ago, that the exchange traded funds can get the job done for very broad themes very cheaply, and need to make sure that you're getting a good price for what you're looking for. And I guess ultimately, though, the big one is paying for more than you need. So, or including more in the themes than what you'd be looking at. And as an easy example there being the climate control versus or climate change rather versus tobacco, and so I've got an example here of the beta shares one, which I've pulled from Responsible Returns. Obviously, very broad thematic, ethical exchange traded fund, but then of course the downside being that if you're ambivalent against or about any of the options in there, they're included. So obviously they're going to ultimately wear the effects of being out of those markets. So something to definitely keep in mind when you're choosing a suitable product. What we'll do now is open up once again for Q&A, and there's a little bit of a delay we've noticed in our broadcast time, so that gives us a couple of moments for you to tap away a few questions if you like. And while you do that, we might just quickly run through just broadly what we do at Nucleus. So we, as I mentioned before, use a separately managed account structure, which we feel offers unparalleled transparency. So all of our clients effectively have their own individual stock portfolio that's managed by us. Now, obviously, custodianship is a key part of knowing who's got your money and basically who's looking after it. And in effect, through our choice of Linear, who's our separately managed account provider, we think we've nailed that with ANZ being our cash manager, ultimate custodian, and also JP Morgan, who's obviously one of the largest investment banks in the world, looking after the custodianship of any shares through us. On top of that, of course, we do offer 19 different ethical screens that you, as the investor, have the ability to choose from. If you have a quick look there, we'd like to think we're fairly broad and we should be able to cater to most tastes, although I'm always happy to take feedback on any new things that you think might need to be added. But look, the key thing here is, and one of the things I found fascinating, is probably one of the reasons for the webinar today, is that when we initially went out to our first sort of clients, for want of a better word, we actually didn't advertise the ability for people to do this, and yet in the first couple of months, 2 out of 3 investors have chosen at least one ethical screen. So it shows that there is, I think, a lot of demand for what we do out there, and I like to think we do a great job at it, and long may it continue. So just finally, obviously, on top of the 19 individual ethical screens that can be switched on or off by yourself as the investor, we like to think we provide a complete investment solution. As Damien mentioned before, we aim to be around about the 1% mark all in, including our investment management fee of 0.64%, and then the platform cost of Linear on top, rounding it out to around about 1%, depending on what you're invested in. Obviously, wealth of experience in the investment managers looking after the money, and feel free to click on the people link above the video there on our website to check out who's who in the zoo. Complete transparency with the separately managed account structure, and which typically, because you do own the shares on an individual basis, you'll find you get all the benefits from a tax perspective on dividends, franking credits, and individual ownership. So with that, we will just jump quickly back to Q&A. We've got a couple of email Q&As in here, so I'll just run through that. And this one, I think, is headed in Damien's direction here, but it centers around resources. So what do you think of resources in the ASX from an ethical standpoint, Damien?
Your resources are always a tough one. I mean, it's a lot easier on the coal usually gets kicked out, but when you come back to a lot of the mining ones, it tends to be a difficult one for people to work out how to sit within the portfolio. It's less of an issue on an international perspective because mining is such a small percentage. But within Australia, that's basically
banks and miners.
Yeah, we're banks, miners, and a bit of real estate and everything else. So the question coming back if you're looking at an Australian ethical fund is very much to how do they deal with the mining because that'll make a big difference to your performance versus the market.
Okay, oh, excellent. And second question there, we've got any more live ones? No live ones. Okay, that's all right. Just in regards to obviously maybe a secondary function of finance. So obviously Adani, is in the news at the moment. Pretty easy to see why that might be knocked out for people, from a carbon standpoint. But what about secondary things like the question here is banks lending to Adani? What's your view on banks lending to Adani?
Yeah, these ones are very tough to do. It's most ethical ones that I know of don't try and do the two steps because if the second step you can end up
most of the market.
Exactly, you end up with so many things that are so close. So I think there's a lot of what you find is there are people who do the shareholder agitation for change and things like that, and so a lot of it comes from shareholder associations and things like that, okay. Talking to these people about we think we'd be better if you don't do this or better if you don't do that. So but in terms of ethical managers who look at things 2 degrees from the source, look, I don't know of any just because it is so difficult. You can try. There's certainly some who try, but I think it's something which, as Tim said, can wipe out the entire market with that, or almost the entire market.
Okay, no, very good. Well, on that note, look, we've just about hit the 40-minute mark. In fact, we have. So we'll sign off here. But look, if any of this is interesting, please feel free to be in touch. Hit the Contact Us page. You can send an email. You can give us a call on the 1300 number or book a phone call with myself. If you click that link, it gives you access to my diary. If you'd like to know more about Nucleus in general, feel free to zoom around the site. And also there's a link in the bottom, which is getting started with Nucleus, a little tab on the bottom right-hand corner, blue tab. That gives you the ability to log into our onboarding portal, where you can have a look at basically setting up the ethical screens. You can choose from our investment suite or get some advice as well. And finally, you can obviously the system creates a personal document for you to get a full picture of what we can do for you and how we may be able to help. But on that note, we'll of course, yeah. Actually, Matt's just reminded me we will be sending out a survey as well, an email survey, just to get a little bit of feedback on today's webinar. Thoughts on how we might be able to improve it, or if there's anything else you'd like to add. And finally, there's some topics there for any future webinars. If you'd like to let us know what we can put together for you, we're more than happy to help. With that, I guess we'll sign off. Thanks very much.